Electric vehicle startup Canoo files for bankruptcy, ceases operations. Filing comes weeks after Canoo furloughed remaining workers and idled Oklahoma factory. The medium-duty electric vehicle space continues to get smaller. 7-year-old electric vehicle startup Canoo has filed Chapter 7 bankruptcy and announced an immediate halt to operations. A press release noted the liquidation process is being overseen by a bankruptcy trustee in the Delaware Bankruptcy Court. Canoo Incorporated, once listed on the Nasdaq Composite under the ticker symbol GOEV, was a notable player in the EV market, particularly in the electric cargo segment. Despite its partnerships with NASA, the Department of Defense, the U.S. Postal Service, the state of Oklahoma, Walmart, and other groups, the company struggled to secure the financial backing to sustain operations. The bankruptcy filing cites unsuccessful attempts to get financing from the U.S. Department of Energy's Loan Program Office as a significant factor leading to Canoo's insolvency. Nor did efforts to obtain capital from foreign sources stave off bankruptcy. Canoo had total liabilities exceeding $164 million against approximately $126 million in assets. "We would like to thank the company's employees for their dedication and hard work," said Chairman and CEO Tony Aquila. "We know that you believed in our company as we did. We are truly disappointed that things turned out as they did. We would also like to thank NASA, the Department of Defense, the United States Postal Service USPS, the state of Oklahoma, and Walmart for their belief in our products and our company. This means a lot to everyone in the company." Leading up to the bankruptcy, Canoo faced numerous challenges that compounded its financial instability. In the final months before the filing, the company furloughed its remaining employees and idled its factory in Oklahoma City. Despite having agreements to deliver electric vans to high-profile clients, Canoo struggled to ramp up production and secure broader market adoption. The company's third-quarter financial reports revealed a persistent net loss, with a GAAP net loss of $112 million for the 9 months ended September 30, 2024, compared to $273 million in the same period in the previous year. Executive departures and strategic pivots further aggravated operational struggles. In October, CFO Greg Etheridge and General Counsel Hector Ruiz resigned, replaced by internal promotions. Under Aquila's leadership, Canoo pivoted its focus from consumer sales to commercial fleets, which involved multiple shifts in production strategies and operational realignments. These changes increased operational costs and diminished investor confidence. Financial mismanagement also played a role in Canoo's demise. Regulatory filings indicated that the company borrowed substantial funds from Aquila's financial firm, including a loan of approximately $1.2 million at an 11% interest rate and an additional $2.7 million later. These loans were secured by assets located at Canoo's Oklahoma City facility, placing additional strain on the company. Furthermore, Canoo's attempts to adhere to Nasdaq's listing requirements through a reverse stock split were insufficient to reverse its financial trajectory. The company's liquidation process involves a bankruptcy trustee managing the sale of Canoo's assets to repay creditors. Stakeholders, including employees, suppliers, and investors, stand to receive proceeds from the asset liquidation based on their claims. Canoo's decision to enter Chapter 7 reflects the company's inability to restructure its debt and continue operations. Canoo's bankruptcy reflects broader trends and challenges within the EV industry. The market is witnessing a series of failures among startups, particularly those that went public through mergers with special-purpose acquisition companies. Companies like Electric Last Mile Solutions, Fisker, Lordstown Motors, Proterra, Lion Electric have all faced struggles from bankruptcies to reorganizations in recent years. Arrival sold its assets to Canoo last March. For the EV startup ecosystem, where substantial capital is required to develop technology, scale production, and achieve market penetration amid intense competition and high operational costs, volatility has been a recurring theme. The liquidation of Canoo's assets will likely have ripple effects across its supply chain and partnerships. Suppliers are already filing lawsuits over unpaid bills, with Kistler Instrument Corporation seeking $56,000 in damages. In Walmart's case, the halt to operations is not expected to be an issue because the deal was a non-binding agreement to purchase thousands of EVs. The liquidation of Canoo may present opportunities for asset acquisition by other players in the EV market. Canoo had developed innovative technologies, including steer-by-wire systems and modular vehicle platforms, which could be valuable assets for competitors looking to enhance their technological capabilities. Breaking down EV startup Canoo's bankruptcy. Not every EV startup is a success story. Summary. Canoo Incorporated filed for bankruptcy and ceased operations, joining other failed EV startups like Lordstown Motors and Fisker. Despite promising prototypes and high-profile clients, Canoo's financial mismanagement led to losses of $488 million in 2022 and $303 million in 2023. The company's inability to produce vehicles at scale, delivering only 22 vehicles in 2023, exacerbated its financial troubles. Canoo's use of a SPAC to go public in 2020 provided quick funding but added public pressure, revealing flaws in its financial planning. The fallout raises doubts about the viability of small EV startups in an increasingly competitive market. Canoo Incorporated, the electric vehicle startup with prominent clients like Walmart and NASA, has filed for bankruptcy on Friday and will cease operations immediately. Canoo joins the list of EV startups that failed recently under similar circumstances, such as Lordstown Motors and Fisker. These companies were essentially using up cash faster than they could secure new investments. Formerly known as Evelocity, Canoo, which entered the scene in 2017 as a disrupting EV startup, finally succumbed after 7 years of promising prototypes, unable to secure additional sources of capital to relieve its severe financial strain. The company is liquidating its assets in a Chapter 7 proceeding in the Delaware Bankruptcy Court. But what went wrong? Canoo was aiming to be a pioneering brand in the EV arena. Why? Despite having what appeared to be an exciting lineup and offering futuristic designs and features that no other brand had, did Canoo fail to reach its potential? Canoo's financial mismanagement. Canoo's financial troubles were no secret, and the last couple of years would set the company up for failure. First, in 2022, Canoo posted a staggering $488 million loss. 2023 wasn't far behind. The company lost $303 million and another $118 million halfway through 2024. By the time Canoo filed for bankruptcy, the company had less than $50,000 in assets and liabilities exceeding $10 million. This financial imbalance was the result of years of overspending and underperformance. A significant portion of its struggles can be traced to its inability to produce and sell vehicles at scale. Despite ambitious production goals and a state-of-the-art facility in Oklahoma, Canoo only delivered 22 vehicles in 2023, generating less than $1 million in revenue. This inability to monetize its innovative concepts put immense strain on its resources. And to top it all off, Canoo's spending on executive perks, such as a $1.7 million private jet for CEO Tony Aquila, raised eyebrows and further eroded investor confidence. Unfortunately, its misaligned priorities and operational inefficiency sealed Canoo's fate. The SPAC factor, a common trap for EV startups. Canoo's road to becoming a publicly traded company via a SPAC in 2020 was very similar to how most EV startups have been doing it lately, mostly for the same reasons too. Although the SPAC route gave Canoo an easy way to raise $600 million in its initial public offering, it also placed the company under immense public scrutiny and pressure for quick delivery. Although SPACs provide quick access to capital, they often fail to provide their startups with solid foundations. Canoo shares similarities with other SPAC-backed startups such as Lordstown Motors and Electric Last Mile Solutions, who have also struggled to strike a balance between their ambitious plans and the financial discipline necessary to achieve them. Reliance upon external funding rather than solid revenue generation built precarious financial structures. Looking back, Canoo's SPAC merger reveals a theme that will become all too common: incredibly optimistic projections with little to no follow-through. The SPAC boom of the early 2020s has been more detrimental than beneficial for EV startups, as a wave of bankruptcies has swept the sector. Canoo's bankruptcy is a cautionary tale for the EV industry. This becomes particularly true for new entrants looking to carve out a niche in a market dominated by established automakers. Despite partnerships with Walmart, NASA, and the U.S. Postal Service, Canoo couldn't overcome its financial and operational challenges. The fallout raises questions about the viability of small EV startups in an industry that demands both scale and sustainability. It also highlights the need for realistic planning, disciplined spending, and a focus on execution rather than hype. Startups must also navigate the complexities of manufacturing, supply chain logistics, and consumer trust, all of which Canoo struggle to manage effectively. Lessons for the EV industry. As the EV industry continues to evolve, Canoo's story serves as a reminder of the high stakes involved. For aspiring EV companies, the lessons are clear. Bold ideas and innovative designs are not enough. Long-term success requires strategic planning, financial discipline, and a commitment to delivering on promises.